Gold is stealing the spotlight, climbing past $3,670 an ounce to fresh records as investors brace for Federal Reserve rate cuts and rising global risks. Central banks remain steady buyers, and forecasts now see the metal pushing towards $3,800 by year end. Well, Senior Portfolio Manager at Sprott Asset Management, Ryan McIntyre, joins me now to chat about the market setting. Ryan, thanks very much indeed for your time.
Absolutely. Thanks for having me.
Gold climbing past 3,670 an ounce. Ryan, near record highs. What are the main forces behind this particular surge in this cycle?
Well, I think gold's been very strong for the last several years. Central banks, I think, have had a lot to do with that ever since the Ukraine-Russia crisis broke out. Them looking to diversify their foreign exchange reserves, particularly. So central banks have been big buyers. So I think that's been a bit of the backbone. But more recently, I would say it's a lot more driven by ETF flows in terms of gold-backed ETFs taking on new bullion. And to me, they've been big buyers since about May last year. And flows there are up about 14% in terms of new gold added to those ETFs. So I think that they've been big buyers. And that's really contributed, I think, to some of gold's strength as institutions really reassess the risk levels and their own portfolios for that matter.
Ryan, I see ANZ now are forecasting gold at $3,800 by year end. Do you see that as realistic, or are prices running ahead of fundamentals here? What's your take?
Well, I think in the short term, no one really knows. And 3,800 actually, from a percentage standpoint, isn't a huge move from where it is today at about 3,650. And so to me, that's 100% realistic. And, from my point of view, gold has done very well since, the U.S. got off the gold standard in 1971. And so, from that standpoint, it's appreciated about 8% a year or so. And so a move like that would add another couple $100 easily to gold price.
Let's talk about the metal versus the actual stock, right, from mining companies here. What are you seeing as a trend in recent months? Are the mining stocks catching up with what bullion is doing?
They're starting to, for sure. Last year, I think, mining stocks were very disappointing in terms of performance, dramatically lagging gold price. And this year, I'd say it's a bit of the catch up for the gold mining equities. They've definitely done what we thought they would do. Typically, when gold price moves 1%, we see the equity prices for gold mining companies move about 2%. So it's sort of a 2-for-1 ratio. And this year, we've sort of seen that, I think, come back into play here. But the biggest thing to me is that, even still, with gold companies doing very well financially and even share price performance-wise, you've still seen outflows in the gold mining equity funds across the board up until about a month ago. And so to me, that's one of the things that's been a major difference between gold mining equities and, physical gold, basically, where you've seen inflows for at least a year now consistently.
Against that backdrop, what should an investor have his or her eye on here? Because it can get catchy at times, can it not?
Yeah, absolutely. And, I guess our advice here for investors, we think of physical gold as a strategic allocation that should be permanent in someone's portfolio. And we think about a 10% allocation is the right amount over time. So to the extent that people aren't in the investment today, we would recommend sort of legging into it, sort of not just picking one day to put the 10% position in, sort of averaging over time. And to the extent that, the percentages move to a large degree over that allocation, potentially trimming along the way just to make sure it's right-sized for the portfolio.
Look, I see silver is trading near a 14-year peak alongside gold. Does it offer the same safe haven appeal, or is industrial demand here a limiting factor?
Yeah, you're right. It's about 50-50 in terms of industrial versus sort of investment or monetary thinking. And so as a consequence of that is silver typically is a little bit more erratic in its behavior. So it's definitely a more volatile commodity compared to gold because you are getting, some of the economic sensitivities affecting the industrial demand But on the other hand, you also get typically a retail component coming on the investment side. And so, from our perspective, silver is probably one of the more interesting commodities in the sense that it does have that dual face to it, both the monetary element that gold obviously has, but also the industrial element. So it's one of these metals that we think should be owned because you actually get benefits of both, particularly in this environment, in our view, because, things that use silver are only increasing, such as solar and some other things like that.
Equally interesting is copper, isn't it? I mean, it's up about 13% this year, boosted by, and I mentioned this earlier, the AI infrastructure, then we have the energy transition demand. How durable is that story for you, just given the trade risks at the moment?
Yeah, no, I think it's unquestionable that more copper will be used in the future. There's no doubt about that. And the biggest factor is on the supply side, to what extent that the copper producers can keep up with the demand. And to me, that's going to be really the determinant of the price. And, the interesting thing about supply, whether it's copper or anything else coming from the mining world, is that it's really difficult to bring on new supply. And you often have supply risks as well over time, whether it's weather related, as we're seeing more climate change events, or even now geopolitical, as people, get into increasing conflicts around the world. So that's always makes things tougher on the supply side.
Yeah. Ryan, I want to wrap up on what you mentioned earlier, the Federal Reserve expecting to cut rates soon. But what if that move is smaller or slower than markets had hoped? I mean, would that ripple through equities and commodities? How do you see it?
Yeah, I think from the gold side, if the rate cuts were lower in number or in quantum than people were expecting, I think it might have a very short-term effect. But I think there's a much larger play here from an investor standpoint for gold. And to me, that's trying to get a diversifier given the amount of uncertainty that exists currently in today's world. And in our view, the uncertainty level is very high on many huge issues. One of the big things, obviously, is geopolitical conflict. And the next one is economics. Obviously, a lot of the Western countries are running huge fiscal deficits on top of huge amounts of large amounts of debt outstanding. And to us, there's some existential problems that I think exist when you have that sort of feature where you really have no prospect of repaying any of that debt. And in fact, given that we're running such huge deficits in, frankly, relatively prosperous times, is a bad omen. Things were to turn down and we're in a bad fiscal position. So I think a lot of things could be on the table that might not otherwise have been.
Yeah, it's going to be interesting to watch. Well, Senior Portfolio Manager at Sprott Asset Management, Ryan McIntyre, thanks very much indeed for talking to us.
Thank you.